Americans for Fair Taxation presents the weekly Chairman's Report, written by Steve Hayes, president of Americans for Fair Taxation, and recorded by Bob Paxton, a volunteer with the Florida Fair Tax Educational Association. And now, this week's Chairman's Report.
Hello, I'm Bob Paxton with the AFFT Chairman's Report for Friday, October 11th, 2024. Increasing the corporate income tax rate makes no sense. Congresswoman Carol Miller, Republican from West Virginia, penned an op-ed in Fortune on how a higher corporate tax rate would hurt Americans by driving up prices and reducing wages, as well as affecting America's standing in the global economy. Here are some of her comments. The Democratic presidential nominee, Vice President Kamala Harris, has argued that increasing the corporate rate to 28% is a fiscally responsible way to put money back in the pockets of working people and ensure that billionaires and big corporations pay their fair share. However, the clear economic truth is just the opposite. Raising taxes on corporations will raise prices for consumers, and inflation will spike yet again. The Tax Cuts and Jobs Act that passed under President Trump in 2017 lowered the corporate tax rate from 35% to 21%. In 2018, 263,000 manufacturing jobs were created and wages increased by 3%, that according to the National Association of Manufacturers analysis of Bureau of Labor Statistics data. Many economists have credited the Tax Cuts and Jobs Act for America's continued outperformance relative to most of the world's advanced economies. Multiple studies show that corporate tax increases are directly passed on to consumers in the form of higher prices. A higher tax rate will also make American exports more expensive and companies less competitive in the global market. The result will be slower economic growth, fewer jobs, and less innovation. A lower corporate tax rate keeps costs down, leading to lower prices for consumers and more investment in their workers. The reality is that if the corporate rate goes up, the burden will fall on consumers, employees, and retirees. As a small business owner, if I suddenly must pay more in taxes, I either have to cut back on investments into the business that create more jobs or pass increased costs on to my customers. This would happen to businesses around the country and would slow economic growth in the U.S. to a grinding halt. While some may argue that the federal government is leaving money on the table by maintaining or lowering the corporate rate, the opposite is true. The Tax Cuts and Jobs Act grew the American economy to the extent that the significantly lower corporate tax rate was offset by increased tax collections. The U.S. government doesn't have a revenue problem, it has a spending problem. Thanks to the Tax Cuts and Jobs Act, the 21% corporate rate has kept business taxes low, which softened the blow from the Democrats' ill-advised and utterly misnamed Inflation Reduction Act. Without the Tax Cuts and Jobs Act, inflation would have been much higher. That's why even Democrats refused to hike the rate or repeal the Tax Cuts and Jobs Act when they had full control of the House of Representatives, the Senate, and the White House. In conclusion, Congresswoman Miller exposes the urban myth promoted by many in D.C. that taxing corporations taps a new source of funds at no cost to Americans. A for-profit corporation is a legal entity registered with a state that is owned by the people who own its shares. Now, a nonprofit is owned by the public and controlled by a board of directors that has no shareholders. Now, almost all corporations are private, meaning that their shares are not available for purchase on a stock exchange. Almost all of these are pass-through entities in which the corporations themselves don't pay tax. Instead, the company's income is reported on the owner's tax return, and the owner pays the tax. Only 4,000 corporations of the 9.1 million corporations in the U.S. are public and have their shares listed for sale on a stock exchange. An American with an IRA, a 401k retirement plan, or pension almost certainly owns shares in one or more of these public corporations through their retirement plan or in their personal investment portfolio. Now, a public corporation's earnings are a big factor in determining what the corporation's total value is. The value of a public corporation's shares is calculated as a multiple of its earnings. The amount of that multiple varies by the type of public corporation. As an example, if a public corporation earned a net profit of $10 million and has a multiple of 5, then that corporation is said to be worth $50 million. If there are 100,000 shareholders in that corporation, then each share would be valued at $500 per share. It's simple math. In the above example, every dollar of additional corporate tax that has to come out of the corporation's profits lowers the corporation's overall value by $5. Now, since corporate management is often judged on how well they maintain the company's overall value, the people who run corporations are often desperate to find other ways to offset increased taxes. Now, higher prices are the primary way that corporations offset higher taxes. But many times, market conditions don't allow them to offset the entire tax increase with higher prices. In those cases, the corporation will look to cut costs. Now, often that means laying off people, not giving raises to employees, and cutting dividends to shareholders. Now, some politicians declare that a corporation has a moral duty to pay higher taxes out of their profits. But the economic reality is that paying higher taxes out of their profits is the last thing a corporation wants to do. When a corporation is taxed more, they raise the money to pay the taxes from consumers, their employees, and their shareholders. Now, the obvious point not addressed by Congresswoman Miller is that if a 21% corporate income tax rate creates more economic activity and benefits, then how much better will a 0% rate be? If more foreign-based companies are moving to the United States because the rate was reduced to 21%, how many more will come if that rate is reduced to 0? If you not only reduce the corporate income tax rate to 0% and eliminate corporations paying Social Security taxes, as the fair tax does, then the competitive pressures in a free market economy will ensure that the lower costs that companies enjoy will get passed on to consumers in the form of lower prices. In addition to the above benefits, the fair tax provides a number of other great benefits. The fair tax is so simple that everyone can understand it and comply with it without having to hire expensive professional help. The fair tax shows the true cost of the federal government on every retail receipt so that all of us can understand how much we're paying in federal taxes and determine if the benefits we're receiving are worth the cost. It helps U.S. companies compete with foreign competitors and not be required to move overseas in order to stay in business. The fair tax keeps jobs in the United States rather than exporting them to other countries. It permanently establishes the solvency of Social Security and Medicare. It eliminates special treatment for any group of taxpayers, and the fair tax benefits lower income groups more than the present income payroll tax system does, and it is fair. In addition, the fair tax eliminates the need to file tax returns and eliminates the need for the Internal Revenue Service. The fair tax allows us, not the elites and their minions, to determine the amount of federal tax we pay and is the largest transfer of power from D.C. to the people since the Constitution was adopted. The American people will overwhelmingly support the fair tax if they're given the chance, and all of us will benefit from its enactment. The solution? Pass the fair tax. Now, why would D.C. pass the fair tax and give up an almost unlimited source of donations? Well, they won't, at least not voluntarily. The only way they will is if the rest of us demand it. Now, isn't it time to end this ludicrous tax collection system and the IRS along with it? Now, there's going to be a vote on the fair tax in the House of Representatives. We now have the opportunity to force all members of the House to show where they stand. They can vote for the present income payroll tax system, or they can vote for the fair tax. They can support the corrupt income tax in the IRS, or they can vote to eliminate it. It can't be any simpler than that. They can hide the true cost of their government, or they can pass the fair tax and show everyone the true cost of government on every retail receipt. And finally, they can support the largest transfer of power from the government to the people, the fair tax, or they can vote against it. Now, if members think the fair tax needs to be amended to address a problem, they can propose the change. Don't let them get away with rejecting the entire bill because it has a perceived flaw that can be easily addressed, and if it's a real flaw, corrected in the final bill. and don't think for an instant there aren't any flaws in the income tax. Help us bring about real tax reform and stop future IRS abuses. By contributing or investing $10.40 a month, you help provide a financial base to Americans for fair taxation. Now, if you can make larger contributions/investments, these will be used not for salaries, as we're all volunteers, but for the needed updates to our economic studies, which will be vital for all future years. Please go to fairtax.org to invest in AFFT and help us pass the fair tax. It's an investment in your and your family's future.
This has been the Weekly Chairman's Report, written by Steve Hayes, President of Americans for Fair Taxation. Check back every week for news and information about the fair tax, and learn why the fair tax should replace our antiquated federal income tax system. If you'd like to receive a copy of the Chairman's Report in your inbox every week, sign up at fairtax.org.